for the past really almost year is an equity market that is at an all-time high, absolute all-time high, and we're poised for a correction. We've seen little corrections along the way that are kind of testing the waters, but I don't think certain factors in both the Fed and in the market have happened yet to see that full-blown correction. However, we started to see that yesterday for the first time at the size that it was. So, talk to us a little bit, Brian, about what this correction could look like, what we are anticipating, and what is driving it.
Yeah, thanks, Diane. I think it's important to preface it by saying, this is really about risk management. It's not about market timing, but it is germane to talk about some of the facts. So, to your point, we had some volatility yesterday. Today is February 24th, 2026. So, yesterday the Dow closed at almost 49,000, 48,827. That's up, if you look over the past year, about 13% over the past year. It's up about 59% over the past 5 years. Now, the Dow Jones is just 30 stocks, so probably a better indicator is the broad-based index or the S&P 500. That closed at 6837 yesterday. That's up about 15% over the past year. It's had a good year, 80% over the past 5 years. So again, strong equity market performance, even going back further than that. Yesterday, to your point, we did see a correction. Most of that, I think, was driven by some of the tariff concerns and some of the news that we've seen coming out of the Supreme Court and the president's proposals. The Dow Jones fell 1.7%. Sounds like a little amount, but it was big. It was an over 800-point drop yesterday. The S&P, in turn, fell a little over 1%. Again, this time was around tariff concerns. Next week, it could be on earnings estimates. Every quarter when those come out, they obviously have a big impact on the overall market. Could be geopolitical tensions like we're seeing in the Middle East and Central America. Those obviously can have an impact on the broader markets. And I think as we talk about something that we've also discussed on prior episodes, and that's the price earnings for the S&P, just basically what typical earnings are for the companies that make up the S&P. They're currently trading around 30, but a better measure is a cyclically adjusted ratio, which is really about 40. Now, to give you some perspective, we haven't seen those levels of earnings since the dot-com bubble in 2000. That's been 25 plus years. Historically, your earnings should be around 17 or 20. You could argue for high-tech growth companies, maybe 25, even 30. But we've also talked about this. Those earnings have largely been driven by what I think a lot of us have heard about, the Magnificent Seven. Those are the big NVIDIAs, Apples that make up currently about a third of the total market capitalization for the S&P 500. We talked to an investor the other day, and it was kind of interesting. If you do an X-ray on most portfolios and identify what percentage out of all of your holdings might be invested in one of the single companies that make up the Magnificent Seven, most people might be surprised. You might have a diversified portfolio. However, when you break into that and look at underlying holdings, individual holdings in those portfolios, good chance a big chunk of that is NVIDIA, Apple, and others that make up, again, part of those Magnificent Seven. So
Well, diversity is a unique thing that you bring up. And you talked about, this is more about I think you said this is more about risk management, not about timing the market. So many people try to time the market, and let's face it, the Wall Street day traders cannot effectively time the market perfectly every single time. And so when you've got a novice trader or somebody that's managing their own portfolio, or even many financial advisors that are trying to time the market,
yeah,
the likelihood of that happening is just it's not going to. And so, what nobody is telling you is it's not about being bearish. It's not about timing. What nobody is telling you is it's about being prepared. It's being prepared for opportunities. And you mentioned diversity, and many people think that they're diversified because they're in the S&P 500, but they're not necessarily prepared for what's going to happen when this market corrects, because that S&P 500 is so out of alignment and focused around those magnificent seven right now, and that's really what's driving them. What's your thoughts there?
Yeah, I mean, when you think about, where the markets are at the type of extreme levels that we're at, our job, we would never encourage anyone to time the market to your point. The job isn't to predict the exact day of a pullback. It's to make sure you're not overexposed in one of those companies. And again, a third of it making up the market cap, a good chance are you are overexposed in some of those
Overexposed
high
is a
tech,
good
high growth,
word.
those high tech, high growth stocks. So the job is diversification, not just within the public equity markets, but across asset classes. And so I think it's important to look maybe going back a little bit more on some of the biggest market declines, because we've seen a few blips. Obviously, COVID was a blip. But if you go back and historically look at some of the biggest declines, the Great Depression was the biggest one. Everyone knows about that. We saw an 89% decrease in the market back in the 20s. The oil crisis in the 70s, we saw a 52% pullback.
In the
Interestingly,
80s.
as you know, Ty, we also saw some of the highest interest rates in the 70s continuing into the early 80s. I think the Fed's rate was over 12%, and it
Yeah.
remained that way for over a decade.
I've talked to investors and I've learned from Trump. I sat with Donald Trump's right-hand man for a number of meetings, and you know, he he talked about how so much opportunity was created in a market when interest rates were at an astronomical high, and really from the correction of those interest rates thereafter and the opportunities that came that we're facing right now.
Absolutely. Dot-com bust, 52% pullback. Fed funds rate was, I think, in the high fives, probably touched on sixes.
Yeah.
The last big one that we've had, again, taking out the blip that we've had in COVID, was the 2007, 2009 financial crisis. A little over, I think, mid 50s, also 54% was the pullback. So it took 12 years, by the way, to recover from that. That was kind of known as the lost decade or the lost dozen years. And again, we saw a Fed funds rate north of 5% during that. COVID, we saw a pullback as well. But as you know, in the past 4 to 5 years, we've seen the Fed funds rate over 5%. So, what does history tell us about navigating volatile markets? Mainly, they're worth navigating. You do have to have proper execution and proper asset allocation. And I think it's important to differentiate that. A lot of people think of up as safe. I've done well in my gold or my precious metals performance. I've done well in the S&P performance, and they have. I've done well in the S&P. A lot of other of our investors have done well in the S&P, but the truth is, the higher the climb, the more painful the drop if you are over concentrated, which we've talked about. If your net worth is primarily in public equities, it's really a way of saying I'm okay that volatility dictates my lifestyle and my decisions. And it's important to look back beyond the past couple of years, because the goal isn't to avoid risk, it's to choose the risks that you can control. Look, all investments come with risk. If there was no risk, there would be no returns. But you can manage the risk, not by market timing. Again, we don't want to encourage people to market time, but it's around effective asset allocation. Um, some terms that I really like. It's not really about being bearish; it's about being prepared for the future. And when everything feels easy and everything's going well, that's usually when the risk is the highest.